But we were already doing 400 companies a year in 2014. At the time, people just thought was fucking insane. Like that was just like a scale that nobody had ever done before. We didn't do all through Accelerator, but we did 375 investments that one year. People just thought it was like psycho. The really crazy thing was we had enough deal flow. We could have been doing 1,000 investments a year because like we did a whole bunch in one quarter when we had more capital. And I was like, okay, I know we can do the pacing. I don't think people really thought about scale as a weapon as much at that point in startups. People thought it was already insane what YC and other folks were doing. And then I took it to another level that people just thought was absolutely like stupid. I felt like that was the weapon, was the scale, the pace, the geography was critical. And another thing we didn't realize when we first started was the PR hits were also like, that wasn't part of the strategy originally. Then I realized like, oh shit, you could put $10 million to work in one company or $1 million checks into 10 companies or 100 checks of $100,000. And guess what? You get 100 PR hits if you do that. Size of the check doesn't matter. You still get the same PR hit for the most part. And so that was a unique sort of insight like, oh, we do lots of small deals. We get lots of PR. People think we're more important than we really are.
That's a golden nugget. Aman, what do you think, just watching and participating in the accelerator kind of come up? How has it changed? What do you like about it? What is it maybe getting wrong?
Let me start with how it's changed. So when Dave started Founded Startups, that was in 2010, there were probably 3 or 4 of these tech generalists who were figuring it out and were able to track really good companies, and Idea Lab was Bill Gross, and
there were a few others, AngelPad, Seed Camp, and a few others. There wasn't like hundreds. There were like, 10 or 15 or maybe, 20 that were at some level of scale. Now there's like probably thousands.
I think my aunt's running an accelerator out of her backyard.
My 15-year-old daughter in Palo Alto is like, for her graduation project, I'm going to start an accelerator. I'm going to start a VC fund, so it's there's Alchemist and SOSV and there's IndieBio and there's, Berkeley's got one, Harvard's got one. If you go for their pre-idea founders programs, we've invested in Ampler and, there's like South Park Commons and Mass Challenge and Seed Camp, and like goes on and on and on. So it's a capital factory. And
you know what? That's great. They should exist. There's nothing wrong with that at all.
Because they're specializing, right?
Lots of small checks. I mean, you might argue there's too much money here in Silicon Valley, but there isn't too much money in, a bunch of emerging markets around the world. Like there's a lot of places in the world with a lot of smart people that don't have millions of dollars of capital just sitting around. And like those accelerators that write 25, 50K checks, those are life-changing amounts of money for people in emerging markets who've never had capital before. Like that's what's amazing about it, is like, not only can you do 100 experiments, CJ, but you can do 100 experiments that change people's lives. Believe me, that was one of the things that like kind of blew me away about 500, because we did stuff in other markets. We invested probably in over 50, 60 countries around the world. People always say like 500 was kind of a cult. Like, yeah, it was a cult. Like it really was. I don't think we understood like in the early days, like how much impact we had. We went to like Mexico or Brazil or India or other crazy places, Southeast Asia. There just wasn't many people from Silicon Valley going to those places. And so some, idiot from Silicon Valley comes over there, writes 10 checks for 100K, and they think like, oh my God, we're like, yeah, for $1 million we can, do a small experiment to open up a country. And like literally they would roll out the red carpet for us. It was a little bit much at times, but they really changed how they thought about themselves.
It is interesting that it's globalizing. The Valley probably is crowded, but there's like Startup Chile and, like McClure Capital's in LA. I think being able to take some of the ways that startups are run, the best practices, how to do fundraising. I'm sure Dave's, deck on how to do an elevator pitch for startups has made it to 193 countries probably are reading it in 60 different languages now. And the ability to take that know-how and take that experience and globalize it is something I think the ecosystem is doing really right. And I think the more you can be specialized and the more that you can actually bring people together with a certain industry or vertical focus to get them to share ideas, I think that works. I think that works really well. And we've seen that replicate across, a lot of these accelerator environments. So I think overall, it's a very active ecosystem. There's, I don't know what the returns are like. Like, I actually don't know if you're to invest in accelerators as an investor. YC is probably the best returning fund out there, but if we take out their top 8 or 10 companies, but if you remove OpenAI, Stripe, and Airbnb, and DoorDash, and Coinbase, like how good is YC really?
That's not how to measure it. I mean, that's the point, is that they wouldn't probably have gotten into those outliers unless they did a large number of companies. And now YC is doing at least 500 companies a year, probably closer to 1,000 companies a year. Now they are doing quarterly batches, and I think they're drawing from, people all over the world. So I think those ideas of scale and geography are now widely accepted. And, people do believe that you can find talent anywhere on the planet. Just got to have an internet connection and, a little bit of capital to get started.
Transitioning from 500 startups to secondaries at Practical VC, it may feel like from the outside the absolute opposite end of the risk.
It is the absolute opposite end.
You guys get it. How do you get there? How did this happen?
I think it was just scratching our own itch. One of the things that I left 500 was we had started to help get a bunch of new funds off the ground. One of the things that was also different about 500 was we started about 15, 20 small VC funds in different parts of the world and in different verticals. And we kind of almost started to be a fund of funds in a way. We kind of did that because we felt like there was local knowledge in a geography or specialized knowledge in a vertical. Japan and Korea and Mexico and the Middle East and all kinds of crazy places. But we also did funds specifically in fintech and in e-commerce and mobile areas. What I kind of found was hey, if I wanted to help find great people and keep them under the tent, you had to give them, something they could feel like they owned. And, otherwise people were going to just leave and went out the door. And several people did start their own funds out the door. But by kind of allowing people to take the 500 brand and modify it and, tweak it for their geography or their vertical and really own some piece of their own, fund, that was an interesting way to sort of scale up the operation. And so initially we were thinking we were going to do this big fund-to-fund platform, help people with, capital raise and deal modeling and portfolio models and all that stuff. And secondaries were one little piece of that to help with liquidity. But it turns out people didn't want to, invest in fund of funds, at least at the time when I was trying to get it off the ground. I wanted to do 100 fund managers globally, and people thought that was a little insane. But they liked the secondary idea. And then I had been trying to sell a piece of carrying my first two funds at 500 and get some liquidity. And I went through the experience of trying to find a buyer and get deals done. It was a real pain in the ass, even though I had some great assets. And I was like, wow, okay, seems like all these funds, when they get to 7 to 10 years old, they start having concerns about liquidity and DPI and exits.
I would have taken that slice if you're still selling it.
We feel like we have good psychology of people who want to sell because we've been that person. And so when I say scratch that itch, I was like, well, I want this liquidity solution for myself. I was able to take about $9-10 million off the table and buy a house and get a new company started. I wouldn't have been able to buy that house without having done the secondary market. I couldn't, use those illiquid assets as, collateral for getting a loan. And, I think largely for a lot of people in the Valley, my guess is 100,000 people in the Bay Area who have between $1 to $10 million of equity in a company. It's probably 10,000 of those people that have between 10 to 50 million. Most of them can't get a loan to buy a home. Homes around here cost $2, $3, $5 million. You probably have to put down a couple hundred of that thousand, maybe $500,000 or more. And you might be sitting on what looks like a big number illiquid assets, but most banks are not going to use that unless it's, something very special like SpaceX or Anthropic. Even a unicorn $1 billion company in the illiquid assets is not a bankable asset for buying a home.
I got news for you. The ERP category is finally getting disrupted. And if you haven't heard of Rillet yet, please pay attention. It's the AI native ERP built specifically to replace NetSuite, and it's already won over hundreds of finance teams. Their mission is to make the zero-day close a reality, and they're actually doing it. We're talking teams closing the books at 1:35 p.m. on the first day of the month. Companies like Windsurf, Mercor, and hundreds of others run their entire finance stack on Rillet. Revenue recognition, close management, multi-entity, native Stripe and Salesforce integrations. Woo! Everything a scaling company needs. They've got 5.0 stars on G2. They're backed by A16Z and Sequoia, heard of them, and CPA-led implementations that get you live in 45 days. That is simply unheard of in the ERP space. If your books aren't running as fast as your business, check out Rillet. Book a demo at rillet.com/CJ. That is RILLET.com/CJ. That's me.